A very good afternoon, everyone. I'm Florence from the Institute of Banking and Finance, and we are delighted that you're able to join us this afternoon for this IBF Masterclass, jointly organized with Lightbulb Capital on blockchain and decentralized finance. We're glad to have with us today the founder of Lightbulb Capital, Daniel Bao, to introduce us to the smart contract-based world of decentralized finance. He'll also be sharing more concepts like stablecoins, governance tokens, staking and slashing, as well as yield farming, as we briefly look at the main benefits and challenges for this technology and its increasing application in financial services. Before I invite Daniel to share his insights, for those of you who may be unfamiliar with IBF, allow me to do a very quick intro on the IBF and the resources we have to help professionals like yourself in the financial industry. The IBF was established by the MAS in 1974 as a training provider to provide functional training for the financial industry. Since then, our role has changed and evolved into one of standard setting for financial services sector's skills and competencies. In August 2018, our mandate was expanded to cover career advisory and job matching functions for the financial services sector. We were also appointed as the Jobs Development Partner for the financial services sector last year by the Jobs Development Council, and now oversee both jobs and skills development for the financial services industry. Here's a quick look at our services and how we support the industry across training, recruitment, and workforce transformation. You can find out more details about these services and connect with us on any of these areas via our website. Since last year, we have also put in place enhanced training support for the financial industry to alleviate training costs during this period. The enhanced course fee subsidies are part of MAS's support package that was announced in April last year to sustain and strengthen capabilities in Singapore's financial services and fintech sectors amid the current economic downturn. The aim of the enhanced training support is to encourage more companies to send their employees for training and upskilling so that they're in a better position to help the company move forward when economic activity normalizes. Enhanced funding support, which was to expire by the end of this year, has now been extended. Training costs under IBF recognized programs will be at 90% from 1st July to 31st December this year, and this will go down to 80% for trainees below 40, while remaining at 90% for trainees above 40 for the first 6 months of 2022, before the rates go down back to pre-crisis levels. To encourage companies to continue sending their staff for training allowance will also be extended for company-sponsored trainees till June next year. You can find out more details about training support on our website. You can also find the list of eligible training programs on the IBF Program Finder on our website. In addition, the IBF will also be supplementing the commercial training available with free webinars during this period to support the training needs of the industry. Financial professionals can also tap on the Learn at IBF mobile learning app for bite-sized learning at your own leisure. All these complimentary training are quoted with non-core CPD hours. And that concludes my short intro. I'll now hand the time over to Daniel as we examine the world of decentralized finance. Over to you, Daniel.
Hello, everyone. Hi. All right, let me see whether I can share my slides. Here we go. 1 second. Okay, can you see my slides?
Yes, we can see them.
Excellent. Okay, good. Okay, so we have about 55 minutes to cover content that I usually teach in a 2-day class in the university. So some of these things might be a little bit rushed, but then again, this is a teaser to foster your appetite to investigate a little bit more into decentralized finance. I want to try and make this session also a little bit interactive. So if there are questions, then by all means, let's see how we can address them. I'm going to configure the chat window here to my right so that I can see your replies. Occasionally, I might also ask you something. So if you if you feel like it, then please get back and answer the question. There are no wrong answers. So we're a small group of people here just trying to figure out what decentralized finance is, right? All right. This is how you might feel like there's a DeFi fire hose. And what I would encourage you to think about is to take it all in rather than to try and escape from it. Yeah, so it's very good that you're here. That's the first step. But then please also try and absorb as much as possible, and don't just let me talk to you somewhere in the lower left-hand corner of your screen while you're doing something else. Also, what I want to say is we are not going to talk about how great markets in DeFi are and how one can make a killing and all of that. I think what I want to focus on much more is a little bit more the mechanics. How does it actually work? And what are the risks associated to DeFi? This is a brief introduction about myself. Some of you might already know me. I got a heads up from a few people actually that said, oh, we're going to see you in the 3 p.m. session. So hello to everyone who I happen to know. Thank you for joining. In short, my background, I worked in investment banking technology for most of my career, and then stepped out of banking in 2014 to start a company called Lightbulb Capital. And we do advisory and education services and collaborate with universities as well around the topics of innovation in finance. And you can imagine that decentralized finance and also underlying blockchain technology is obviously featuring very, very prominently right now. All right. There's also a bunch of papers. I don't know if you are interested in this sort of thing. I've got one on ICO scams and one on disclosure requirements for token issuers, and then a quite well-cited one on security tokens. But then more recently, I've been also working on blockchain and ESG as one topic, and then obviously decentralized finance, which is part of this DeFi ecosystem. Okay, so let's get into it. But before we start, actually, there's one thing that I have to share with you, and it's that we are basically experiencing these two very, very big trends. On the right-hand side, you can see there's basically a trend from a traditional business towards a platform business. And I think that's a very prominent business model by now, even if we don't consider all of the blockchain-based platforms. You can see things like Facebook and Airbnb and Uber and Grab and so on. They're all platform-driven, ecosystem-driven business models. So that's kind of one thing that helps with DeFi. And then the second one is that more than 50% of the world are now millennials. Yeah, and to show you how different millennials think, from me, old person, for example, I show you this tweet. This tweet is written by a millennial, and he put up this tweet just after the Coinbase IPO. Remember when Coinbase, one of the large cryptocurrency exchanges, listed their shares on NASDAQ? He said, I'll buy some Coinbase when I can do it like a normal person on Uniswap. If you're not familiar with Uniswap, Uniswap is a decentralized exchange that sometimes has higher trading volume than Coinbase itself. So that's kind of the thinking, yeah? And then it's very different from us, where we say, well, I don't know how to operate a wallet, and a private key and a public key is very complicated. But to millennials, it seems to be more complicated to open a brokerage account with, Saxo or Interactive Brokers, and then to adhere to the trading hours in the US, for example, to buy some shares. Quite fascinating, I think. Okay. Now, this is kind of our agenda. A little bit of history. I want to walk you through the problems that DeFi addresses, then also talk a little bit about infrastructure, DeFi primitives, DeFi risks, and then share with you a few use cases, and also what you can do to learn more after this class, okay? And we'll try to do all of that in 50 minutes. Hopefully, we also have a little bit of time for questions. All right, a little bit of history. Let's start with the history. So why is there even fintech to start with? Basically, because when you look at traditional finance, there's lots of inefficiency. And inefficiency, to some extent, drives innovation. Why? Because managers are measured by basically one number in traditional finance, and that is the cost-income ratio. Sometimes even more important than the top line. Yeah? But then also, what other problem do we have? Well, user experience, right? User experience sometimes not so fantastic in traditional finance. And I just wanted to show you, in terms of driving out this efficiency point a little bit more, one example of fintech, but in the context of a big investment bank. This is the trading floor of UBS in Stamford in 2008. And I remember I went there actually before 2008, probably 2002 or so. And at that time, I had my first digital camera, and I had to take 3 pictures to capture the whole thing, yeah, because it was the size of 3 soccer fields. There's about 5,000 people on that picture right now. Yeah? And at the time, we thought, wow, this is like as fintech as it gets, right? All of these traders with all the big screens and so on. 2016, this is what the floor looked like. And trading volumes unchanged. Yeah? So that's kind of a little bit the power of fintech and how much optimization is possible. But is that really the case, actually? Well, it's interesting to note that this paper from 2016 basically looks at financial transaction costs over the last 130 years, yeah? Quite a long time. And yeah, it's pretty much 2%, didn't change much. So all of these improvements that people talk about, including the one that I just mentioned, actually didn't really make a big difference to finance and the transaction costs associated to it. But then what happened in 2008? Satoshi, who we still don't know, is it one person or two, and what type of person? They basically gave us the Bitcoin white paper, and they proposed a technology that we now know as a blockchain technology. And you're probably familiar with some of the features of Bitcoin blockchain. Perhaps you've attended my class or other good classes that are out there. And these are some of the features, right? So it's an immutable ledger, can't be tampered with. It's also borderless. It doesn't really understand the concept of a sovereignty or of a country. Source code is open source, so it's not some proprietary technology which is protected by patent law or something like that. The tokens themselves are scarce. There's a limited number of them, and therefore, if you own one of those tokens, you have to take care of it yourself. It's not like in traditional finance where you have lots of service providers that custodize and assist you, but you have to do that yourself. And some people argue that this decouples it from perhaps current systems and therefore is a good store of value. And whether that's true or not, only time will tell. You can argue both ways at the minute. What happened next? What was the next iteration on the path to decentralized finance? Well, it's the launch of Ethereum. Ethereum, a smart contract platform. And what is a smart contract? Well, as my slide says here, it's basically a term that used to describe computer code that automatically executes all or parts of an agreement, and that agreement is stored on a blockchain. And basically, smart contracts are the tools that we need to build decentralized financial services applications. Okay, and here are some other examples, because after Ethereum, other smart people started thinking about, oh, how can we create even better smart contract platforms? And many teams are working on that. I think right now there are about 86 in the world. But these are 3 prominent ones: Polkadot, Ethereum, and Tezos. And you could add others, Algorand, and so on. All right, so then what is DeFi? Well, DeFi is a group of financial distributed apps that sit on top of these smart contract platforms. It's also a movement, because the people who are involved in DeFi are very different to the people that are involved in traditional finance. And what you'll find is quite a competitive marketplace that offers these financial services. And you can find pretty much any financial service that you know from the traditional space. You can find exchanges, you can find borrowing and lending platforms, also platforms to tokenize, others to manage assets or provide investment management services. They all benefit from what William Kong has actually described in his paper about platform tokens, which is a network effect that helps these platforms to grow. And what's most interesting is that compared to traditional finance, where we have very high cost-income ratios, these things basically just work once they're developed, right? When they're developed, they get deployed onto the smart contract platform, and then they're there and they're for everyone to use. So the only ongoing cost that is really associated to providing these services, if we disregard for a second the addition of features, is basically the transaction cost that is associated to them. All right, now DeFi is a topic that is very swiftly growing, and if you look at this chart, even a year ago or so, perhaps there's like I don't know, under $10 billion in what we call total value locked. And total value locked is basically the amount of currency that is locked into these smart contracts, either as collateral or otherwise. I can really recommend this website. DeFi Pulse gives a really good overview on what's happening in the DeFi space across all of the different services and platforms. But as soon as you look at it, it's already outdated, right? I remember when I first proposed a class to SMU about decentralized finance, and I think the number was around $50 billion. And I went to the program director and I said, $50 billion, we have to have a class on this. It's so important. And then next thing you know, it hit 100, and I felt like so outdated, even though it was like just 2 months later or something. So very fast moving space, which is also the reason why Solana doesn't feature on my previous slide, Carlos. Not because I don't like it, simply because it's hard to keep up with everything. But I do recognize that it's obviously one of the platforms as well. All right, what do we have to say about the problems that DeFi addresses? So there are really 5 problems. The first one is that right now we have to deal with centralized control. There are few players in traditional finance, including the central banks and perhaps a few other big firms, global firms, that basically make the rules. In decentralized finance, that's different. We also have limited access as a problem. I looked it up, and apparently 1.7 billion people are unbanked, and much larger population is what we call underbanked. So perhaps people who have a bank account but don't have access to the financial services that they actually need. Then we have an inefficiency issue. And I don't know whether I'm not a payments or credit card expert, but I looked this up and I realized that sometimes, the credit card transaction cost can be up to 3%, takes about 7 days to settle. So lots of capital locked up if you aggregate across the world, all the activity, and not cheap. Perhaps DeFi has some solution to make those sort of payments much more efficient. There's also lack of interoperability. Anyone who's worked in a bank before knows how complicated it is to stitch all of these different systems together. As lots of people have made a career out of how to navigate these very complex systems. And when you talk about doing something cross-border, different regulation, different type of technology, different documentation becomes even more complicated. And then there's also opacity, which is the lack of transparency, which some of the financial institutions really enjoy because nobody really understands the pricing, and then maybe it's not always the best for the user. And there's another question by Carlos, thank you. Do you think we will have a future of multiple blockchains where up layers like Cosmos will be the bridges? Okay, so yes, I do think that there is a future for connecting different blockchains. And one way is, I think, the Polkadot way, one way is the Cosmos way, and that's definitely very, very important. It's almost like enabling sort of travel lanes between different sovereigns today, if you wanted to compare it. Okay, what do these issues actually cause? Well, they cause slower economic and entrepreneurial growth. And what that means is effectively is that there's even more inequality than there already is in our global society. So while DeFi doesn't really address these issues today, I think there is a very good chance that DeFi can address these issues and improve these issues in the future. So what is DeFi infrastructure? Let's talk a little bit about that. Basically, the things you need for DeFi. So there's a blockchain. We've already spoken about what a blockchain is, some features, but I wanted to really break it down to two things. Some of you might have looked into blockchain quite a bit already, but the main thing here is that blockchain systems are basically allowing you to transact without the rule of law. And if you are in a transaction with somebody in the traditional world and they cheat on you, you can basically go to court and sue them, yeah, because you know who they are. But in blockchain world, we can't sue anyone because we don't know who we're transacting with. So blockchain systems have to allow for incentives, and we'll talk a little bit about incentives later, that make sure that people behave well, yeah, in the absence of you being able to sue them. That is one very critical thing to understand. What else do we need for DeFi? Well, the most prominent use case for blockchain is probably cryptocurrencies, right? And what do cryptocurrencies do? Well, through the use of blockchain technology, they allow us to resolve this double spending problem of digital money. The fact that you can't really just copy your money and spend it twice. Yeah? And it's based on what we know as a public-private key cryptography concept, where your public key is a little bit like your bank account and your private key is a little bit like your password. It's also characterized by being peer-to-peer, so you don't need all of the intermediaries that you perhaps find in traditional finance today. If I wanted to transact with somebody else, I can do that directly with them and use the blockchain technology. And it's also censorship resistant, which means, at least for public blockchains, we don't really have this entity that could censor any transactions or any data that is being passed around on the blockchain. What else do we need? Smart contract platforms are a little bit dumb in the sense that they only know what's going on top of themselves. So since much of the action happens outside of blockchains today, we need what we call oracles. And oracles are basically data feeds, verified data feeds that send data to a blockchain. And that's a very important concept if you think about pricing of securities, for example. We'll talk a little bit about what is called oracle risk later, but I'm also conscious of time, so I'm hopping through a few things here. Another concept that is very important in the context of DeFi are obviously stable coins. Yeah? Why? Because other cryptocurrencies like Bitcoin or others are very, very volatile. And basically, what we need is something that is a little bit more constant in value. Otherwise, we always have this issue that each transaction could basically cost us more or less money than we anticipate because the price changes so quickly. Yeah? So the idea is peg or create a peg to a stable currency, for example, the US dollar. And then I see that there are a few questions. Let me just see. You can try and answer. Could you give us an example of an oracle in the real world? So there's a company called Chainlink. You can look up Chainlink. Maybe that's quite interesting. And can you give you a use case as well? So if you think about catastrophe risk insurance, for example, you will need some sort of price feed, or not price feed, you need some sort of data feed that confirms whether there has been a, what's it called? An earthquake, for example, right, in Japan. So you need to get that data item somehow, you need to get it onto the blockchain. Then Chainlink is one platform that can help you do that. Okay, that was that. Okay, next, some primitives, basically the sort of financial actions that a decentralized finance developer can use to create their value proposition. So of course we have transactions, right? Transactions are basically the smallest unit on a smart contract platform. And basically what it means is you can transfer data or value from one public key to the next. And these transactions can sometimes include multiple transfers, and can be quite complicated. But what's interesting is that all of the conditions of one transaction actually have to be met. Otherwise, this transaction will fail. Yeah? And if you look at the key risks in DeFi, you will see that there are often risks around so-called exploits, economic exploits. And sometimes they work and sometimes they don't, because perhaps some condition in the smart contract doesn't work. We also have a whole bunch of different types of tokens. So we've got fungible tokens. Fungibility, I'm sure you remember what that was, is everything where there's loads of similar ones around, right? Like the little ducky here, or if you think about oil or dollars or Bitcoin, those are basically fungible tokens. And the ERC20 token standard on the Ethereum platform is also used to create fungible tokens. And if you think about this token standard, it's basically like a template to create a smart contract that represents a token. And it can't really do much. I'm listing here a few of the functions. The last function that I'm circling here is the one that is really important for DeFi, because it allows you to approve certain amounts to be spent within a smart contract. If you don't have that, then you can't really deposit anything into a smart contract or unlock it when it's required. There are also other types of tokens, equity tokens, for example. These equity tokens shouldn't really be confused with what often we call security tokens, which is a digital representation of an investment product. But equity tokens in the context of DeFi are basically tokens that represent pool of assets. You can almost think of them as a little bit of a fund that lives on the blockchain. For example, you could create a token, let's call it the TC1 token, named after one of my students in my first cohort. And that token could basically represent 100 Ethereum tokens. But obviously there's very little limit as to how complex you could structure one of these equity tokens. Now, the question really is, are these equity tokens investment products, digital investment products? And obviously it depends on which jurisdiction you're in, but I think I wouldn't be surprised that according to most of the securities laws in the world, if you create a digital representation of another digital asset, there's a high likelihood that they might end up being security tokens. And what that means, we can perhaps discuss when we have more time than today, because it's quite complicated. All right, we also have utility tokens. So those are also fungible tokens, but they provide a consumptive right to a product or service. And I'm giving you a few examples here. There's, for example, SNX is used for collateralization, or DAI, which is basically is there to create a stablecoin, or Link. We have already talked about Chainlink, the Oracle proposition. So if I ask you, is Ethereum a utility token? Then you could probably answer yes. Why? Because there is also a utility attached to what Ethereum is actually there for. It's not only there for you to hold it and then look at the price increase. Actually, the utility of Ethereum is to be able to pay the gas fees for the transactions on the Ethereum blockchain. Another type of token that we should also know about in the context of DeFi are governance tokens. And governance tokens are basically those tokens that allow you to take some sort of influence on the development of a platform and how the platform eventually evolves over time. So probably come with some sort of voting right that allow you to influence according to the holding. Often is one token, one vote. There are also non-fungible tokens. So those non-fungible tokens, or NFTs, are unique tokens. They only, each token is different. They're not like the duckies that we talked about earlier. And they have their own little standard ERC 721. And I put some interesting examples of non-fungible tokens, whether it's penguins or CryptoPunks. You might have heard of those. Why are these even relevant in the context of DeFi? Is because they could, in a digital asset world, they can be collateral. Yeah, just like perhaps some other fine artwork that you have that may have a value attached to it. All right, what else? We also have the concept of custody. And the concept of custody in DeFi is very different to the concept of custody in traditional markets. What we mean by custody in DeFi is that you are able to basically deposit a certain amount of tokens into a smart contract that then custodizes your asset on your behalf in that sense. And that is important if you, for example, want to use your balance in token A to take out a loan in token B. What else can happen with tokens in the context of DeFi? Well, we have supply adjustment, and we can adjust in two directions. So we can mint new tokens that basically increases the supply of one particular token, or we can burn tokens, mint and burn. Burn means basically destroying tokens by sending them to an address where the private key doesn't exist anymore, for example. All right. Now, I mentioned earlier that there's this whole idea of incentives in the absence of the rule of law. So what are these incentives? We have different types. We have, like I like to think about it as, we have the carrot and the stick. So we can incentivize good behavior. We can also punish bad behavior. So you can basically encourage people to do the right thing by giving them something. That would be the carrot. And then that comes in the form of, for example, staking rewards. But we could also basically punish people for bad behavior. If you think about usually slashing happens when you run a node and then you are not really taking good care of the node. So let's say the computer is off half the time. There's always a risk attached to losing some of your token balance because you are not doing the right thing. Angela is asking, how can one sell all the tokens? What will the person receive after selling them? Okay, so you will receive another token. If you have, let's say, 100 token A, you could probably go to a decentralized exchange. I will explain how they work in a second. And you could exchange them for token B. If you wanted to not have any tokens anymore, you will need to go to a centralized exchange and sell them for real money. So you could sell the tokens for, let's say, US dollar and then wire the US dollar into your bank account. But that's slightly outside of the realm of DeFi. What else do we have? Well, we have a funding mechanism in terms of fees, right? So many of these decentralized platforms will have to not only pay fees for the smart contract platforms, but they will also charge you some sort of fee for the provision of their product of service. But that's pretty obvious. So what can we do? What kind of financial services do actually exist where we have this concept of a swap or an exchange, right? Where you can exchange one token for another on an atomic basis. And there are a number of different decentralized exchanges that make this happen. But I think the most interesting one is what we call a automated market maker. And an automated market maker works very different to a limit order book, which is kind of what most traditional exchanges use in today's world of finance. And basically the way it works, because this is sort of a key part of the presentation, I guess. The way it works is that as opposed to the limit order book, where the limit order book basically facilitates the buyer and the seller to meet at a certain price for a certain quantity. In the context of an automated market maker, you have basically two very different type of market participants. You have one market participant that we shall call liquidity provider from now on. And what that liquidity provider does is they lock two balances in token A and token B into a smart contract. Let's say 100 Ethereum and the equivalent of, I don't know, some sort of stable coin, maybe USDT, for example. And as soon as they've locked in those two tokens into this automated market maker smart contract, they can walk away. They don't need to do anything. Okay. But what they're doing is they're basically saying, I'm locking in my tokens in here. So if anyone wants to, buy or sell one token for the other, they can for a certain amount. And you can imagine if there's many, many different liquidity providers, then the aggregate sum of token A and token B can be quite big. So that whoever approaches the automated market maker can then also execute their trade. And that brings me to the second player of this decentralized exchange game, if you like, and that is the trader. So the trader basically has a single-sided interest. They want to just buy one token or sell another token. And they can signal that by basically keying in a trade request, if you like, which will then be answered by or with the liquidity that liquidity providers provide. Okay, and why is this thing called a constant function market maker or a constant function market? Is because basically we have this constant k in this equation that you can see over here. What do we see here? Let's just go through this real quick. So there are two tokens, X and Y. And we already said one might be Ethereum and one might be DAI. And if you have $100 worth of Ethereum, you can multiply by 10 Ether, you have 1,000, and then you have $1 DAI price, which means you need at least 1,000 DAI to get to 1,000 as well. So then when you multiply those two, you get 1 million. And what that means is that if there is a change in the quantities of X or Y in the liquidity pool, then K still needs to remain the same, right? And that's what we kind of see on that little animation on the other side. Basically, if we are giving away X, we need to take Y in so that 1 million always remains 1 million. If we had more time, I would love to discuss in detail how these things actually work. But the one thing that I want to leave you with is that liquidity providers are exposed to a risk called impermanent loss, which is the risk they take compared to holding X and Y assets without putting them into these liquidity pools. And the second thing is that there are also decentralized exchanges that operate in a more of a, market order limit book. No, what do you call that? Limit order book, sorry. So if you want to learn more about this, then please come to my class, then we can discuss a little bit more in detail. I see that we have some questions, so let me just quickly go through them. Where do I start? Does it make sense to be an LP and a trader at the same time? Okay, so some people do that. I guess most people probably do that. There is one paper that suggests that providing liquidity for tokens that don't have very high correlation is not a very economically sensible idea because of this impermanent loss issue. Lucky is asking, does it need to be the same value for X and Y? No, so X and Y can absolutely vary. And you can imagine that if I add token X and give token Y, then perhaps the price will be out of whack. So how do we then get back to a price that is competitive with other marketplaces? That's when arbitrageurs come into play, and they will then basically equalize this price differential by perhaps trading on other decentralized exchanges or even on centralized exchanges. Carlos is asking, as we're going towards a DEX world, what do you believe will be the future of centralized exchanges? That's a very good question. I think, Carlos, until we don't have a solution for the conversion of fiat money into tokens directly, there will still be a role for centralized exchanges for now. And then Lawrence is asking, how are platforms like Olympus and ClimaDAO able to pay such massive APY? If there is something that sounds pretty incredible and too good to be true, maybe it is too good to be true. That is all I have to say at the minute. Michelle is asking, how do you envision the regulators would approach DeFi? Yeah, this is a very good question, Michelle, and it's actually a very complicated one because we don't know who the actors are, right? And everything in traditional finance is based on regulating individuals that participate in the financial services ecosystem. And then suddenly we're in a world where that doesn't really hold. So there's a very interesting paper by a friend of mine, Professor Douglas Arne of Hong Kong University, who is thinking about implementing regulation on the smart contract itself. So I would encourage you to read that, and it's a very interesting forward-looking paper. Okay, what else do we have? We also have not only exchanges, but we also have borrowing and lending. And you can imagine that borrowing and lending I mean, that's what finance effectively is for all we know, right? So very powerful, but then also quite risky because all of these different platforms eventually hang together. So there is also a consideration around systemic risks. And we need to also acknowledge that in the blockchain world, there are many adversarial actors, people that try to hack and steal because they can. So that is very, very important to understand. And to Lawrence's question, some of these higher interest rates that are being paid are perhaps also compensation for the risks that we will discuss later on, and they are not small. Yeah, even for things where you think, this is just a stable coin, it's just a US dollar. Why, there's free money if somebody pays me 20% for my cash. But then we need to think really in detail, is it really cash? How is it different from cash? Perhaps there are some risks associated to these stable coins that make it different from cash. And therefore, the higher interest rate compensates for that risk. Okay, let's move on a little bit. There's also the concept of tokenization. Tokenization is basically creating representations of off-chain assets or other on-chain assets on a smart contract platform. And you could have, for example, a digital representation on Ethereum that represents one Bitcoin, right? There's an example called WBTC or wrapped BTC. So it's one digital asset represented on another blockchain platform. But there are also platforms, for example, SEP protocol, that allow you to create assets on chain that only exist off chain. For example, stocks or baskets of stocks. I don't know whether you've seen recently, but there is a whole discussion around a platform called Mirror, and then SEC subpoenaed the founder of Mirror, very interesting. And then he sued the SEC back because of a formality error. So this is a very hot topic, yeah, discussed with all of the regulators. And I wouldn't be surprised if this is something that will have to drastically change. Huh? Wherever we have sort of common concepts that exist in traditional finance and we're trying to replicate in DeFi world, there's always tension. Okay. There's also asset management. So asset management on blockchain comes in the form of perhaps what we can call aggregators or robo-advisors. And Federico is right, XTF is a very good example. Not only for asset management, but also for the creation of investment products on a blockchain platform. And thanks, Federico, for joining, actually. Very cool to have practitioners around the table as well. So these systems basically allow you to hold different portfolios of tokens in your wallet. And it kind of opens up a whole new business line, if you like, because so far, if you wanted to be a fund manager, it's a regulated activity for most of the securities products, so you can't really do it without a license from the regulator. But then suddenly in the blockchain space, everyone can be a portfolio manager, right? So there's probably lots developing and lots that we have to watch very, very carefully. Also because alpha opportunities that some investment managers have rely in traditional finance on information advantage. So if suddenly everyone can be an investment manager, perhaps these things disappear at a much quicker pace than in traditional finance. So what looks fantastic at the beginning might actually not be that interesting, but then only time will tell. We can also depict derivative contracts on blockchain. And if you think about it, smart contract platforms are actually ideal to host financial derivative contracts because you can basically make sure that they execute automatically. But the issue with it is that it's very difficult to roll certain contracts or amend them, right? If you think about OTC derivatives, for example, of course, you have some sort of ISDA layer where everyone agrees, yeah, these are the basic terms. But then right now in traditional finance, if on top of ISDA, there are other agreements that two parties have agreed to, and they want to change these in mutual agreement, they can. But on blockchain, everything's immutable, so they can't. So it's going to be very interesting to monitor very closely whether we will see more standardization of derivatives or how these things could perhaps be abstracted. All right, oh man, the time is flying. I'm sorry we are only where we at, but let's talk about the risks. And for the risks, I have a little video to show you, okay? And I hope that this works. So we tried it before, and let's see whether it works. So this is decentralized finance in a South Park context. Okay, I don't know whether you know South Park, but let's just check this out.
How can I help you, young man?
I got a $100 check from my grandma, and my dad said I need to put it in the bank so it can grow over the years.
Well, that's a really smart decision, young man. First, we'll buy some BTC with that money and then convert it into REN BTC via cross-chain atomic swaps. Then we'll deposit that into a Curve LP liquidity pool to earn compounding interest and tokens. Then we'll stake those tokens via Mentor to get even more CRV and BAL tokens. And it's gone.
What?
It's gone. It's all gone.
What's all gone?
The money in your account. It didn't do too well. It's gone.
What do you mean? I have $100.
Not anymore, you don't. Poof.
Well, what can I do to get back
I'm sorry, sir, but this line is for bank members only.
I just opened an account.
Do you have any money invested with this bank?
No, you just lost it all.
Then please stand aside for people who actually have money with us. Next, please.
All right, this is a little clip, and why I put it in here, even though we are hosting a rather serious event, is because it kind of describes very nicely that there are a lot of risks associated to DeFi, and sometimes quicker than you can look, poof, it's all gone, right? So please, I would encourage you to obviously experiment with everything DeFi, and I think it's very exciting, but you should also be very, very careful because some of these mechanisms and interrelated activities quickly can make you lose money. So this is something that I would encourage you to understand in detail before you actually use it in a more meaningful fashion. Okay, very, very important. So what I'm going to tell you over the next few minutes is not going to make you understand all of the risks, but at least I want to share a few important risks. So the first one is called smart contract risk. So that means something goes wrong with that smart contract. And there are two types of issues. One is basically a logic error in the code. The other one could be an economic exploit, where perhaps some actor takes advantage of different pricing levels or different availability of liquidity on platforms to manipulate the price and then basically extort you that way. So it's very, very early, and now we have new companies who are basically auditing these smart contract platforms in DeFi, and they will probably be quite an important player going forward. Okay. We also have governance risk. So governance is where basically, you know, humans try to figure out how to agree on something, right? And I don't know whether you have heard about this Uniswap issue that we saw the other day. Basically, a number of people proposed something to the Uniswap Foundation, you know, teach DeFi to everyone over the next 5 years. The foundation said, yes, here's 20 million worth of Uni token. And they had a cash flow projection in their grant application that said they would slowly sell those Uni tokens over the next 5 years. And on the day they got access to the tokens, they sold half of it, $10 million. So what it shows us is that we are not quite there yet when it comes to governance mechanisms of these platforms. Okay. Okay. Douglas Arner from Hong Kong U is that professor. I just put that on chat 1 second. Yeah, you can find his paper on the SSRM platform. Okay, and then there's also Oracle risk. We briefly talked about Oracle risk. So what do they do again? Get data onto a smart contract platform, right? And it's very important that some of this data, especially if it's pricing data, for example, can be put onto the blockchain that eventually will immutably record these records in a tamper-resistant fashion. Yeah, so we need to be able to trust. That's a bit of an interesting word in the context of blockchain, but we need to make sure that the data that comes from the Oracle is indeed legitimate data, and that it is not legitimate is basically what we call Oracle risk. Yeah. There's also scaling risk. Yeah. Some of these platforms, including the biggest one, Ethereum, has massive scaling risk. Why? Because the way it's architected at the minute is not really designed for so much traffic. And that's why, you know, other platforms, including Carlos' favorite, Solana, is able to scale much better than Ethereum. Yeah? And scaling often has to do with what type of consensus algorithm you're choosing. If you are ever wondering whether proof of stake, which is sort of the more novel approach to consensus building, is secure enough, then I can recommend to read this paper, Blockchain Without Waste, Proof of Stake. Is a very good paper that got published in a top journal and is perhaps quite insightful. Oh, okay. Oh, okay. Chat, all good. Okay, thank you. All right, there's also DEX risk. So DEX risk is the risk that we have already discussed a little bit around impermanent loss. Unfortunately, the session is not long enough to cover everything in detail, but there are also risks associated with validators of the blockchain cheating in the context of these decentralized exchanges. And then I think we also mentioned that if token A and token B are not really correlated to each other, this risk increases and makes yield farming not really a profitable activity. Okay, so there's a bunch of growing literature that I'm hoping to be able to contribute over the next few months as well, because it's really interesting how this automated market maker or constant function market maker process works. It's nothing like what we know from traditional finance. Last but not least, I think there is also regulatory risk. So of course, I think somebody already mentioned, you know, how do we identify who are the actors, right? That is an issue. There's obviously regulators trying to investigate some of these companies that have built some of the decentralized services. And our current SEC chair, Gensler, says, you know, DeFi, even though it's called decentralized finance, is actually not so decentralized finance. It's more DeNo, not DeFi. And DeNo means decentralized in name only. So actually centralized platforms that pretend to be decentralized. You know, many other questions whether these governance tokens that come with voting rights, for example, are securities, yes or no. Taxation is very unclear. Many things to be found out in the future. So one thing that I would definitely recommend to you is, if you are interested in learning more about this, it's not something that you can learn in a kind of a one-shot way. You need to update yourself on a daily basis. I do that as well. All right, so in summary, DeFi is young, but growing very fast. And what's interesting is that a whole new financial ecosystem is developing, while traditional financial services are trying to incrementally tweak here and there, but they still sit on their very bad cost-income ratio. There's this new ecosystem coming about. So that makes me ask my question, how can traditional financial services institutions be part of DeFi? Perhaps that's worth thinking about, because if you just optimize and optimize and optimize what you have, eventually you become irrelevant, same as Kodak or Blockbuster, or all of these examples that you've probably heard from innovation scholars 500,000 times already. Okay, what else do I have to share with you today? There's a very good book that I want to recommend to you, written by 3 authors. Main author is Campbell Harvey, very important finance professor. So if you are interested in understanding more of the mechanics of DeFi, this is an excellent book. There are some other reading materials that are related to DeFi, and those I can probably also, oh, there's the Decentralized Finance paper by Douglas Arner, the second one actually. Good that I have it on here. If you're interested in understanding the basics of blockchain technology, please come to my class at SMU. It's this one. And if you're then interested in understand even more about DeFi, there is a course that we launched, I think last month, called Decentralized Finance, a new financial ecosystem. All of that is kind of irrelevant if we don't have the right culture. So I'd also invite you to explore a little bit how to improve or tweak or optimize your company culture by checking out this IBF approved program that my colleague Derek Aris is running. It's a very successful program. We have clients that send the whole cohort of fresh grads to the program. We have other clients that say the one downs from Exco need to learn more about innovation. So it's really something that is good for, let's say, all sorts of financial services professionals at the different maturity levels and sophistication. All right, that's it. We don't have much time for questions. I'm really sorry about that, but if there are some questions, perhaps now you can put them on chat. Please also note, I'm quite active on LinkedIn, so if you wanted to follow me, that's perhaps a good idea. And if you have any follow-up questions that we couldn't really discuss at length in this very short teaser session, then please feel free to reach out. I mean, I think LinkedIn is probably the easiest, but I'm leaving my email address here with you as well. So very happy to kind of engage further and discuss, because it's a topic that I'm very interested in personally as well. So I don't know, any questions before we close? Oh yeah, welcome. Thank you for attending today. It's a real pleasure, Friday afternoon. Obviously, we glossed over a bunch of details because there's not much time, we could do much more. Okay, then I guess we'll leave it here. No more questions. Thanks again for attending. I really appreciate it, and have a fantastic weekend ahead. And then please be in touch if I can help you any further. Okay, thank you so much for coming. Bye-bye.
Then there are a couple of questions on Q&A.
Oh, there are? Oh, yeah. Oh, I didn't see that.
You can click on the Q&A button.
Oh, I didn't see that. Oh, yes. Okay. John, who actually does due diligence on this DeFi system to ensure the... Okay, John, this is a great question, because, due diligence basically would require that we know who the actors are, right? Which in traditional finance, we know, oh, there's a new fund manager, there's a new, I don't know, an exchange. So then we can do due diligence, but we can't really do that in the decentralized space where these systems are eventually more decentralized than what Gary Gensler believes they are. So it's hard. The companies that develop these software tools are often being looked at now, and regulators are interested, but there is no regulatory regime for DeFi at the moment, yeah? Which is why there's also a lot of fraudulent activity. Yeah? But that doesn't mean that it's all only for criminals, because the issues that we have seen before, that we discussed before, are real issues, yeah? And decentralized finance could eventually help with the resolution. Okay, who else? Edwin, is there a process where DeFi will ban a recurring perpetrator who DeFi? Okay, so Edwin, this is a good question. And the answer is, to some extent, actually, yes. Because if you, if you are an actor that is, that basically doesn't do what you should be doing, there is this idea of slashing. If you get slashed multiple times, eventually you lose all your stake, and then you're sort of out of the ecosystem. Yeah? There is also another approach which deals with the ability to identify wallets that have been used in sort of fraudulent activities. So that is another way. Okay, that is basically it. Thank you very much for coming. And it would be my pleasure to stay in touch with you. And also thank you to the team at IBF, who's obviously doing excellent work with these sessions that me and many other colleagues across different countries are participating. So thank you for hosting me today. It was a real pleasure, and we'll stay in touch and collaborate further. Okay, have a great weekend.
Thank you so much, Dan. And
Bye-bye.
we've now come to the end of today's session. Thank you once again for joining us. You may stay connected with us via LinkedIn and our websites. For those of you who have dialed in via phone, do email us at events@ibf.org.sg to let us know the number you dialed in from, so that we can send you the certificate of attendance. The COA will be sent to all participants registered emails within 5 working days, together with recording of this session. Thank you once again, and have a good time. Have a good weekend. Bye, everyone.